Unlike the initial expectations of an 8 to 10% drop in the overall power demand in fiscal year 2021 led by COVID-19, the power demand has actually seen a swift recovery in the second quarter of the current fiscal year. And if the market is right, the government's reform and capex plan could be a big trigger in the second half as well. In our ideas for profit today, I'll discuss about one company which is well geared to take the advantage of this recovery that is in the offing. Power Grid Corporation. While Power Grid did not face major challenges due to COVID-19, the good thing is that the end market is improving with the demand reviving going forward. Also, the recovery in capex and liquidity issues easing as a result of the government support. Now, this is visible even as during the worst affected quarter of June, the company posted a 3% year-on-year growth. Now, that is in revenue and largely on account of a 5% growth that was seen in the transmission segment that accounts for about 97% of the overall revenue. Also, there was marginal impact of the lower capitalization of the ongoing projects due to the execution and also due to other issues. Now, during the June quarter, the company did a capitalization of mere 1200 crore rupees, which was lower by 16%. Thankfully, the situation is considered to be much better in the September quarter, and the company also expects a good recovery in the capitalization of projects in the second half of the current fiscal year as a result of bunching up of the projects under construction. Now, the management also expects to do a capex of about 10,500 crore rupees, and that's along with the capitalization of about 25,000 crore rupees as well. Now, the company is executing about 11 projects that are under construction. Higher traction of these projects means a greater impact on the profitability going forward. Now, the company also recently received the government's approval to monetize its assets through InvITs and to raise about 10,000 crore rupees. Now, this is positive as the company would be now in a position to procure equity capital for its own projects. Now, the earnings visibility is also improving and the capitalization rates are also expected to be better. Besides, if you see the higher the cash flows, asset monetization and also the expected recovery in the consultancy as well as the telecom business, they should actually yield better earnings going forward. Now, we do expect about 5% growth in the revenue in the current fiscal year and a good 8 to 10% growth in the fiscal year of 2022. Earnings could now grow even higher with the improvement in utilizations and higher margins led by contribution from most of the segments also. Now, also if you see, what is really worth noting at this point in time or at this juncture is the valuations that have now turned quite attractive due to the recent corrections in the share prices. The stock is also trading at 6 times the fiscal year 2022 estimated earnings as well. Now, on the basis of the price to book value, it is around 1.1 times as against the historical average of about 1.7 times. Interestingly, it is also currently offering close to say 8% of dividend yield. So therefore, investors could look at the stock from the perspective of the historically low valuations and also offering strong dividend yield.